Another form of CVP analysis is the break-even analysis. The target profit analysis is great from an optimistic standpoint. What do I have to do to get more than what I think I need to sustain? The break-even analysis is more or less the question, what do I have to sell in order to simply break even and cover all my costs with a profit of zero? So the break-even analysis is the level of sales at which sales revenues equals total expenses and the profit becomes zero. So I sell enough to maintain all my costs and I have nothing else after that. More or less, this is the bare minimum a business would like to see. This point can be calculated again in terms of units or sales revenue, dollars, using the following profit equation. So if you remember us talking about the profit equation, USP times X minus UVC times X minus FC equals operating income. In order to move this or convert this to a break-even analysis, all we have to do is switch the operating income to zero. Because remember, break-even just tells us what it is at a zero level of profit. From our simplified version, what we're going to do is we're going to look at, it used to be fixed cost plus operating income over UCM. We're just going to get rid of the operating income. It now just becomes fixed cost over UCM. Again, because this is divided by the margin, this is going to yield an answer in units. Again, if we want it in dollars, then we're going to do the same equation except our denominator will be in a ratio, contribution margin ratio. That gives it to us in dollars. So let's look at an example. So assume that the company has the following income statement and they want to know how many units need to be sold in order to simply break even. So right now they're selling 500 and they're getting a net operating income of 10,000. How many do they have to sell in order to get a net operating income of simply zero, which we would expect to be lower than 500 units? So let's go through the equation. So there's our equation, fixed cost over unit contribution margin. Our fixed cost is 5,000. Our unit contribution margin, as it states, is $30. And if we do that division out, that's going to let us know that we need to sell 167 units simply to break even. So instead of selling 500, we need to sell 167 for that net operating income to be zero. Enough for us to cover all of our costs, and that's it. Now, what if they ask, well, what do you have to sell, or what do we have to sell in order to break even? How many dollars do we have to sell? Instead of selling $25,000 worth of sales to get 10,000, what do we need to sell in dollars to break simply even? Let's look at our example again, our equation. This time we're going to divide it by the contribution margin ratio. So our fixed cost again is 5,000. Our contribution margin ratio again is done by calculating the $30 contribution margin divided by the 50, which gives us 0.6 or 60 cents. So we'll divide it by 0.6, and that's going to give us a number, a total an amount of dollars that we need to sell in order to break even. So in essence, in order for us to have a net operating income of zero, we don't have to sell 25,000, we need to sell 8,334. And that's how you do a break-even equation or break-even analysis from a units perspective and a dollars perspective.